Welcome to RJTI Charts. Today I'm going to discuss why you shouldn't be buying at these levels, but okay, do as you see fit. If you are new to the channel, please subscribe, like, and share for more interesting content.
RJTI Church. Why you shouldn't be buying at these levels, but okay, do as you see fit. September the 16th, 2025 at 9:14 p.m. Why not just wait for the dip to come? That is inevitable. We get it. We understand how insane and how unwise this idea seems to be, especially since the markets continue to scream higher almost every week. But we ask you, is it impossible that markets could fall? Just think about this, if we may ask you to ponder. Between year 2023 and currently, the undertone was that the markets were moving higher because the FOMC was to cut interest rates, especially since the FOMC had announced in year 2023 they were going to cut interest rates several times in years 2024 and 2025. But did it happen? No. FOMC reversed their course and the markets put in about a 50% premium from such expectations. And the other 50% of rise for the stock market value came from the Magnificent Seven, led by Nividia. Yes, in year 2025, we just might be getting a cut for interest rates in September 2025. But what about the unsubstantiated 50% of premium that the markets added falsely? Is it possible that the gains made since April 2025 could return lower to, as displayed on this chart? Our answer is that it is impossible that the laws of physics and the laws of mathematics will not have its season when such laws command for conformity. This is why it's so dangerous to be buying around the highs, and many have already put themselves in a vulnerable state. You listen to the overly optimistic fund managers and financial stations, appearing analysts, etc., and they tell you there's only up, and so you have no risk, and they speak only up. But did many of those same fund money managers, analysts, tell you before years 2000, 2008, 2018, 2020, 2022, 2024, 2025 plummets that everything was fine and there wasn't any downside risk? Here's our truth. We signaled or warned all of the 7 major stock market declines a year before things unfolded. Although markets are screaming and we sound like the boy that cried wolf, all we can say is that our cry in the past has given us what most would not dare to say, and that is the last 7 major stock market declines we called. But the past is the past, right? We agree. So let us tell you that the rally is to hit a brick wall, and many of the top Magnificent Seven will have a decline of significant proportions, even if another 10 to 15% is added to its current value. Well, if we think that a 10 to 15% rise could come, then why talk about a major decline to come? Because we're warning that the 10 to 15% rise will bite buyers in this range, even more viciously than those who already have significant pain coming that bought in June, July, August 2025. You know what the problem is? Most investors know how to buy, but they don't know when to get off of the train. And poof, their gains vanish. But a lot of the fund money managers are guilty of this too. Is it unreasonable to project that Nividia could pull back to 146.96? The S&P 500 equivalent is 6,027.79. But here's the problem. Exuberant behavior doesn't even want to have a pullback, which is less than a 50% drop based on the range between April's 25 low to the current high. Yet, here's the truth we see. The SP 500 should have already had a decline to retest, if not taken out the 48.3504 level. Yes, that artificial low that we made back in April 2025, 48.3504. Let's look at the difference of the S&P 500 move to the pullback level 6027.79 minus its real suggested 48.35 target, which equals 1,192.75 points. The current high as of September the 16th, 2025 is 6626.99 minus 1,192.75 equals a pullback to 5,434.24. This would be an okay result, yet keep in mind that it would still be 599.2 points from retesting the artificial low made April 2025. What are we saying? We're offering that at some point, the laws of physics will supersede the rah-rah of investors, fund money managers, and when, not if, but when it happens, one will come to know that it's good to know when to get off of the train. Or at least know that it's okay to take some profits off of the table sometimes. As you look at this graph here, you can see that we've got our double yikes range, our yikes range, and our yikes range, which we're already in. And we can see that artificial low, 48.3504. It's easy to see the trees that make up the forest, and it's even easier to see the forest that's made up of trees. But it's not so easy to see behind the forest. Get your Rambo today. rjticharts.com, driven by infinite wisdom and its proprietary trading systems.